There are over 7,500 ETFs, with 12 alone that are designed to track the performance of the FTSE 100. Each ETF has its own key investor documents, annual reports and fact sheets, and so trying to figure out which ETFs are a good investment can be kind of tricky when you're just starting out. Here we're going to analyse the iShares Core FTSE 100 ETF by looking at who administers it, the past performance of the underlying index, the tracking error and the risks and the costs involved. The ETF was set up in the year 2000 and is designed to track the performance of the largest 100 companies in the UK, aka the FTSE 100 index. The company who administers the ETF is BlackRock, but who is BlackRock and what is iShares?
BlackRock is a global investment manager and has been serving the UK for over 20 years. Their European headquarters is based here in the City of London, not too far from the Bank of England. Back in the 1990s, Barclays and Morgan Stanley launched their very first ETFs as a collaboration in response to the newly created SPDR S&P 500 ETF by State Street. Their first ETFs were called World Equity Benchmark Shares, or WEBs for short, but these were then later rebranded by Barclays as iShares in the year 2000. Then, in 2009, Barclays sold iShares to BlackRock, who now manage over 800 ETFs globally, making them the world's largest provider of exchange-traded funds with over $2 trillion in assets.
So the team at BlackRock ensures that all of the right shares in the underlying index are purchased and tries to minimise the tracking error. That is, the difference in the price fluctuations of the index and of the ETF. If the price of the index goes up by 5%, then the price of the ETF should go up by 5%. For example, the fund manager in charge of the iShares FTSE 100 ETF, let's say Susan, uses your money to purchase all of the shares in the FTSE 100. These are AstraZeneca, BP, Unilever, and all of those really well-known UK companies. So, although there are 100 companies in the FTSE 100, they aren't all invested into equally. Instead of each company receiving 1% of the ETF funds, the top 10 companies in the index receive 42.8%, as this is based on their market cap, with AstraZeneca being the biggest holding at 6.98%. That means the smaller companies in the index, such as EasyJet, receive just 0.1%. Now, that's fine, as long as a fund manager bothers to invest in all these smaller companies. Many ETFs will not bother to invest in these smaller constituents, given that it can just take up so much time and have such little effect on the performance of the ETF. But the iShares FTSE 100 ETF is what we call a full replication ETF, meaning that it's expected to purchase all of the shares in the underlying index in order to minimise the tracking error. To check this, I downloaded the constituents of the FTSE 100 and of the ETF and then matched them up. Sure enough, it's a perfect match. But these constituents aren't static, as the FTSE 100 only tracks the largest 100 companies in the UK. That means some of the smaller constituents, such as EasyJet, are due to fall out of the FTSE 100 on the 22nd of June. The ETF constituents are rebalanced quarterly. This means that the performance of the iShares FTSE 100 ETF matches that of the FTSE 100 very closely. Here you can see the FTSE 100 in red and the iShares FTSE 100 ETF in green. Over a 10-year period, the tracking error of the ETF is just 0.21% per year. This means that if you were to invest £1,000 in the FTSE 100 index and £1,000 in the ETF 10 years ago, then the ETF would underperform the benchmark by around 0.21% per year. So this shows that the ETF does a great job tracking the FTSE 100, but is a FTSE 100 even worth tracking? You might have seen in the headlines that the FTSE 100 value is the same now as it was about 20 years ago. In the chart, you can see that the price at the end of May is at around the same level as it was back at the start of 2001, at just under £61 per share. This is a red flag, as it shows that the FTSE performance has been very poor. In fact, the annualised return from the year 2000, when the ETF was set up, has been a measly 3.07% per year. This means that if you include all of the capital gains and the dividends that the investors have received, then their investment has only grown by approximately 3% per year for the last 2 decades. Investors that purchased shares in 2000 had to wait until 2014 for the share price to recover to the same level at which they invested, if dividends are excluded anyway. When we compare this to the S&P 500, the index which contains the 500 largest companies in the US, we can see that the annual performance is more than double, at around 7.65% over the last 20 years. But what is really interesting here is when we overlay the performance of the two indexes and look at the ratios between them. Back in 2000, the S&P share price was 22% of the FTSE 100, roughly a ratio of 1 to 5. This remained fairly constant until the last decade. In 2011, the price of the S&P was still around 21% of the FTSE, but by May 2020, it's now 49%, giving it a ratio of 1 to 2. This is because the FTSE 100 growth has remained fairly stagnant, whilst the S&P certainly has not. Now, this can be seen in two ways. Either that the FTSE 100 will continue to stagnate, or that the FTSE 100 is due to recover lost ground. But this video isn't about making speculations on what the FTSE will do. It's about whether the iShares ETF is a good investment and a valuable vehicle for tracking the FTSE 100. As with all ETFs, you can find the costs in the Key Investor Documents and the fact sheets. The expense ratio, which is simply the annual charge for holding the ETF, is just 0.07%. I spent some time looking around to see if there's any of the cheaper ETFs that can track the FTSE 100, and there just isn't. Even Vanguard, who is renowned for having extremely low-cost ETFs, have an expense ratio of 0.09% for their FTSE 100 ETF. But it's no good being cheap if you can't buy and sell the investment. For that, you have to consider its liquidity. The net assets of the share class is 8.2 billion. Yep, that'll do. Now you can see next to the net assets of the share class there's an even bigger number. This is because it also includes the net assets of another iShares ETF, which also tracks the FTSE, but where the dividends are instead reinvested. But the iShares ETF that we're talking about has a ticker symbol ISF and is a distributing ETF. That means that the dividends that the underlying shares pay out are then distributed back to you and others that are in the fund. The alternative is an accumulating ETF, like the sister fund to this one, with the ticker symbol ISFD. This is important to acknowledge as it can make comparisons tricky, as it looks like it's significantly outperforming if all of the dividends are reinvested automatically, whereas in reality it's just not the case. Personally, I prefer distributing ETFs, as that gives me the choice to reinvest if I want to, or invest elsewhere in another UK fund or abroad. The ETF base currency is in pound sterling, and that eliminates the currency risk. But of course, the ETF still has other risks. As well as the inflated political uncertainty and the threat of war, many reporters are warning us about the chasm between the stock market and the economy, as stock prices become too detached from the rather dismal fundamentals and the flood of poor earnings reports that are starting to be published. In my opinion though, these are short-term risks, and based on the fact that you're interested in ETFs, means that I could take a guess that you're in it for the long term. One thing that is concerning me though is fossil fuel disinvestment. 3 out of the top 10 holdings in the FTSE 100 are oil and gas companies, commanding a share of around 11%. This means that as green or ESG investing raises in popularity, as extreme weather events continue to intensify, and as the electrification of the transport network progresses, are these companies really a safe bet for long-term buy and hold investors? For me, it's a no, but you might look at the world differently, and so is the iShares ETF safe? Well, yes. The ETF is a UCITS ETF. That means it's governed by certain EU regulation that ensures certain safety standards are met, such as the diversification of holdings and sufficient liquidity. So I'm going to be making a video all about exactly what protection a UCITS ETF has to offer, but for now just remember that the ETF has met certain EU regulation that's in place to protect investors from unsuitable and unsafe investment vehicles. Overall, the ETF is administered by a very reputable company. It has a very low expense ratio, has great liquidity, and tracks the FTSE 100 very closely. But is a FTSE 100 worth tracking? In my opinion, the lack of growth over the last 2 decades and the long-term risks facing some of the biggest constituents means that at the moment I don't have this ETF in my portfolio. And for absolute transparency, I have no vested interest in this ETF whatsoever. It's not in my portfolio at the moment, but it's certainly going to go on my watch list. If you're interested to see what other ETFs are out there, keep an eye on the channel and leave a comment if there's an ETF that you think is really interesting that I could take a look at too. And that it's expected to purchase all of companies a safe bet for the long buy. Many reporters are warning us of